Hi everyone, welcome back to this series of market research using the powerful tool AmiBroker, which I absolutely love. And I also love this video that I'm about to bring to you because it is so cool. It's a short-term trading pattern, and over a certain amount of time it made a serious amount of money. And that trading system, or that trading pattern, is called the Opening Range Breakout. Now, you may have heard of it. It was used by Linda Raschke, I think her name is, of Market Wizards fame, but it was originally published, as far as I know, by Tony Crabel in his book, Trading with Short-Term Price Patterns and the Opening Range Breakout. Now, Tony published this book in the early 1990s and then subsequently tried to take it from the shelves, as far as I hear the stories. Either that or it just went out of publication intentionally. The reason was that the results were actually pretty decent, and now the book sells for around $700 on Amazon. It's very hard to find a copy, but the premise of the system is very simple. The idea simply is this, that we're looking for the narrowest range of the last 7 days, and when that happens, we place our buy signal, and I'll actually just increase this a little bit so we can see it. And what I've done using AmiBroker, which is really cool and probably one of the best things about it, and that I absolutely love doing, is that I've shown all of the detail and the signals on the chart here. So in other words, we've got the narrowest range of the last 7 days, and it gives us this hollow up arrow here. And the next day, that's when we actually make the trade. And the trade is we buy when it trades above the high of that narrow range bar. And I've just put that buy price there. I hope you can see it. That's the that's that little black dot there. And so what I've done also is I've just put in a little bit of slippage, so it's slightly above the high of yesterday. That's so even though we get the buy signal, I've just added a little bit of slippage in there, just, because I want it to be a bit fairer as well. And then it will sell at the close of that particular trading day. Now, as you can see, we've got another narrow range bar there with the hollow up arrow. The next day takes the trade at the opening price because it's above the high of yesterday's bar, and then it sells at the close of that particular day as well. Now, it does have losers, it does have winners, but overall, the results were pretty decent over the last 40 to 50 years of data. So the first thing I want to show you is just a backtest that I did. Now, this is the same data or similar data. This is the S&P 500 that Tony Crabel would have been looking at and basing his initial trading system on. And that is from 1970 to 1980. What we would probably call in-sample results. Now, I've simply coded this system into AmiBroker and let it do its thing. There is no leverage involved, and this is from 1970 to 1980. Basically, and you can see why he ended up using this, and Linda ended up using this as well. We had an annual return of around 60% using this particular method, with a drawdown limited to 3.7%. That's the maximum drawdown. If you were looking at this, you would just be jumping for joy and singing hallelujah because that is really the holy grail of trading systems. Now, obviously that's in-sample results, and here's the other thing. Typically, when someone releases this trading system to the world and people start trading that system, then the results are actually eroded. So the edge of that trading system is eroded. And let's actually have a look at that and see what happens. But that's from 1970 to 1980. If we were to have traded this on the S&P from 1965 to today, we'd actually have a portfolio that started with $50,000 and went to approximately 3,000 million, which, if I'm not mistaken, is around $3 billion. So would you be happy with that? I'm pretty sure I would be okay with that return. Now, there's a few things that we need to consider as well. As you can see, we have that in-sample period from 1970 to 1980, and look at those. The drawdown is so small, it's almost non-existent. That is out of control good. Now, as you can see, possibly when people started trading this originally, the drawdowns start increasing. However, the return is still going up. So the return money is still good. Now, as you can see, Tony released that book in 1990 as well, and the drawdowns were still limited to around about 10%. Now, last week we also looked at a trading system that was the reminiscences of a stock operator trading system. Definitely check out that video, because very similar thing happened here. When the year 2000 hit and we had many more computers, trading systems, and automated trading systems coming into the mix, the reminiscences trading system really fell over. Like it really almost disappeared. The edge completely eroded. Now, a similar thing started to happen with the opening range breakout. As you can see, the drawdowns are significantly increased to around 30% during the last 10 to 15 years. And during that time, from about 2000 to 2010, the returns of this trading system went absolutely nowhere. Now, that was also during quite a few bull markets. We had some good trading conditions during that time as well. But here is the kicker, and this is where it's really, really interesting. Because we were talking about the trading system last week that just completely disappeared, the edge completely eroded. This one, when you're trading during this particular period here, you would believe that that edge had eroded as well. However, in the last 5 to 6 years, it seems as though the edge has come back. So let's just do an actual back test of this particular trading system from, let's say, 2008. So, the actual global financial crisis, to today. And we'll use the S&P 500 just as our example as well. The reason we might use this is because we have the potential to trade a very liquid contract on this one. As far as I'm aware, it's not really my cup of tea myself. However, that's what you'd be looking for a short-term trading system such as this. We'll just start with our normal, $50,000 portfolio, hypothetical portfolio, and no margin, so 100% again. Now, if we just do a quick back test and we'll check the report for this particular trading system, okay, it's not amazing. We've got 13% per annum. However, the equity curve is going in the right direction. So a very, very interesting take on this trading system. It appeared to be broken for many numbers of years, around 10 years, when the results and the details of this trading system were released to the public and it became more known. And it's an amazing thing that it seems to have actually come back to fruition, and that edge seems to have come back for this particular trading system as well. Now, obviously, it won't work on all markets. Definitely check it out yourself. Back test it yourself. It's definitely up to you. These are just the results that I've gotten on this one particular entity, so take everything with a grain of salt. But it is so interesting, and it's a whole bunch of fun to actually look at this data and have it automatically done. I think it's just great, and obviously to be able to see that on a chart as well. I would also like to know your thoughts. What do you think? Is this particular trading system coming back into vogue? Is the edge coming back? Is that even possible? Now that we have computers in the mix and automated trading systems, do you think the edge will erode again, or do you think it will stay, constantly up for some time? Feel free to leave a comment in the in the comments section below, or check out my website. It's asxmarketwatch.com. A whole bunch of free stuff there. Guys, have a great week. Until we meet again, happy trending, and bye for now.